What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Today I'm joined with Josh Green. How are you doing today, Josh?
I'm good. How are you?
I'm fantastic because after all, I don't know if you know this, but we are joined today by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. So that means deal sponsors, it means passive investors, it means operators, syndicators. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of an off-market deal, the private deals that you're not allowed to talk about, sometimes called a 506B deal, then you should know that you need a documented prior substantive relationship, or else the SEC will get ants in its pants, and we don't want that, do we? But the benefit to you of keeping and watching is you will learn how to effectively communicate on the subject of commercial real estate deals and how my guest fits in. And speaking of it, Josh, before we start talking too seriously about deals, do you want to say a thing or two about yourself?
Yeah, no, thanks for having me on. It was good to meet you we met at Raise Fest in Phoenix, so it was good to meet you in person there. Yeah, no, I've been working in real estate for about 20 years in different capacities. I started as a multifamily appraiser and consultant. I did that for about 11 years, and realized after a while I was on the wrong side of those transactions, right? And I should be the investor or the developer on those same projects. I was seeing, how much money they were making on the back end. And so I went back to school. I got a master's in real estate development from the University of Utah here. From there, I went to work for a local, I'm based in Utah, in Salt Lake City.
Mhm.
Went to work for a residential developer here and help with all their underwriting, finance, everything on kind of anything infill and urban. So townhomes for sale, for rent, up to 200 plus unit apartment projects. And I've always just wanted to do my own thing. And so a couple of years ago, I quit and have just been trying to make a go at being a developer, investor, capital raiser full time.
I love that answer, especially because I had a similar experience coming from CRM and tech funnels. And the way I put it is I'm on the wrong side of the right business, right?
Yeah,
And
exactly.
it's great to see that. But before we get too excited, I gotta say, but wait, check your eight. Now, Josh, I don't know if you can see through the camera and into the user's device down there, but there might be this hideous subscribe button. I don't know why, like it isn't. Okay, yeah, it's a silly joke. But anyway, let's talk motivations. The 5 distinct motivations. I've now, by this point, spoken to at least 1,000 different players in this space, and everybody has their own unique why. This is very true, but I found they fit pretty neatly into these 5 different categories, and it's vitally important for us to know what people's motivations are because these deals take months to close, they take years to go full cycle, so we got to know what's going to keep somebody from throwing in the towel. And the 5
Yep.
categories I've found, the first of which is preservation of purchasing power. What on earth is that? Well, some people, they don't have to have a job. They don't have to have a full-time job to pay their bills because their portfolio of assets is how they make ends meet. And if you're in that situation, you might ask, well, why bother going through the hassle of another acquisition that's going to take all this time and effort and stress? Well, the 2 different main categories of why someone in this situation would make their next acquisition, one of them is when inflation rears its ugly head, it's going to eat away from the purchasing power of your cash flow, so it's going to be time for another acquisition. Conversely, if you can pick up a property that is at a steep discount because of distress or an asset crash, then it's going to be absolutely worth it. And full disclosure, I'm not to this point in my career. What's a more accurate description is that I'm trading time directly for wealth, because as a tech person, a high salary, high wage earner, you're going to find that your tax burden is just ridiculous. And if you're like me, I started making these online funnels for real estate people specifically back in 2014 after owning my agency for about 3 years. I was working for a guy for 6 years who was flipping 10 houses a month for years even before he ended up hiring me. And then I saw the potential there, but I was like, how can I pivot to where I'm getting rewarded for my efforts in the form of slivers of deployed capital, aka equity? So that's what I'm up to. And that's a little too subtle, especially for youngsters and people new to the space. Commonly what they're more up to is they want to fast track their retirement. That might mean hustling like crazy right now so that they can take it easy later. But I think that another variation of this motivation is just wanting to take control of your schedule, which means maybe it's working fewer months per year or fewer weeks per month, or just having your evenings free, presumably, or something like that to spend with your kids, that sort of thing. And honestly, a lot of people who have this as a motivation, they think that secretly it's everybody's motivation and just people are in various levels of hiding it. But I assure you, that's simply not true. For example, some people are just plain ambitious. They want to buy their entire hometown. They want this giant building with their name on it and the yacht and all that kind of stuff. And even though that's somewhat vilified in some circles, the fact is, these people are going to be hustling into their 90s, and so they're very valuable pieces of any business just because they're not going to throw in the towel anytime soon. And that's fantastic to have on a team, just like the last group who they are motivated to keep going, but it stems from they've picked a sector of society, or maybe it's the environment or animals, who knows what it is. But if you're going to make a big impact, there's a big financial component to that, and that's why they are making their commercial real estate acquisitions. So Josh, you mentioned a little bit of your motivations, but just for the VAs in the audience who are writing this down into investor databases, what combination of those motivations would you say describes you best?
Yeah, no, I'm a pretty simple guy. I don't need a building with my name on it. I don't even want that. I don't need a yacht, any of those things. For me, I just want to. My priority is my family. I have a wife and 4 kids, and my priority is just to be there for them. And real estate's the best way that I've found to be able to do that. To have kind of a flexible lifestyle. To have some passive income. And I'm not there yet. I'm not fully passive, but headed that way. And so, yeah, for me, it's that. It's just security for my family, and having that, being having that flexibility to spend time with them. And the other thing is, I really do get a lot of fulfillment out of trying to help other people. Teaching other people about investing in real estate, helping them, help providing them with opportunities to invest in deals. That part is super fulfilling to me too.
I love it. I love it. And one of the things that's kind of fun about that motivation part is I follow it up with a little bit of a dose of reality, which is there are risks involved. It's not all rainbows and fluffy pillows and whatnot. And if you've ever been involved in one of these off-market deals, these 506B syndications, then whoever the securities attorney in the mix was, and if there wasn't one, then that's the biggest red flag out there. You should run, not walk. But they should have insisted that everybody involved fills out this financial questionnaire, sometimes called a suitability questionnaire. And one of the questions just did not satisfy me at all as far as its utility, and it was the tolerance for risk assessment. So I made my own version as a fill in the blanks, which I think gives much more actionable information. And it is. There are many popular investment asset classes, but I think blank is too risky. So Josh, it can be inside real estate, it can be outside real estate, whatever you want, but what's too risky for you?
Oh man, all I know is real estate, and so for me, what's too risky is over leveraging on debt, um, and anything that has kind of I think short term investments I think are more risky. I'm in it, kind of for the long haul. And so I think, a lot of people are hurting right now because they got in that situation of over leveraging and they were trying to make a quick buck. And I'm at the opposite end of the spectrum from from that.
Yep, yep. I love that answer. Yeah, it was the short-term loans that, oh yeah, interest rates are always going to stay low, right?
Yeah,
Wrong.
wrong.
Yeah, exactly. And with your background in the numbers, it's always refreshing, especially when I get to this slide here. As a matter of fact, when I first started these chance encounters, I did not include this slide because I knew that there's some people out there in roles that are really more public relations or marketing, and they're not the spreadsheet jockeys who are up to their eyeballs in numbers. But I started including it because I realized that even if you're just the PR person, you're still going to have a metric or two that more or less tells the story of your deals and other people's deals so you can vet them out. But of course, if you are an underwriter, then every single one of these is going to be important. And for anybody in the audience who's only listening and not watching, I always read out this list. I got 14 on there, not as if that's all of them, but I think a top three or adding your own one is perfectly fine. The first one is cash on cash, then IRR, then cost per door, then net operating income or NOI, then going in cap rate, which really means the difference between the cap rate you're buying at versus other buildings in that exact neighborhood, then the loan interest and occupancy, which is the same, it's inverse of vacancy, then average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it, the difference between the market versus the in-place rents, the population growth where the property is located to have some baked in appreciation right there, the sponsorship record, which means the number of deals that have already gone full cycle and the number of deals that are on the go right now. Then there's the waterfall, split, or exit strategy, which is what happens after the deal is completed in the sense of your capital has been returned. And the last one I have on here, which is straight into what Josh was saying a moment ago, it's called DSCR, or debt service coverage ratio, which means how much of the revenue is going straight to the cost of the loan. So Josh, of these different metrics, what are the ones that really sing to you?
Yeah, I look at the market first is where I start. And so in a good market, I like to see population growth, employment growth. Those are the two most important things to me before even finding a deal in that market. Is I want to see that there's growth there. And then if you're talking about deal specific, I've worked with big private equity groups all the way down to individual investors that are looking at investing their nest egg. And it's different for each of those groups. The private equity guys seem to be a lot more driven by IRR. I think for me, like I said, I'm a simple guy, and the easiest ones to understand for me are cash on cash. If I invest $100,000 in this deal, what am I getting back? I think that's one of the most simplest, like easiest ones to understand. The other one is that I don't think I see it on your list, but yield on cost sometimes we call it. So what's your income divided by your project costs? And what you're looking for there is a spread between your going in cap rate or your current cap rates and what your yield on cost is. And you want to see a margin there. It cuts through IRR and some of these other things. You can kind of manipulate or they're maybe not manipulate, but they're easily affected by inputs and variables, right?
Right.
And yield on cost is really not. It's hard to trick that one. And so from an investor standpoint, I think cash on cash and yield on cost are the two that I'm looking at.
I love that answer because especially if somebody comes with an answer that's not on the card, it means that they're not making it up, which is a problem sometimes, right? But I'm just eating up that answer like a delicious subscribe sandwich, which of course is my very subtle reminder that it's time to bring out the Dan Does Deals Commercial Core Competency Cube, and it has the 6 different roles in a commercial real estate deal. And if you're looking at this and going like, man, I really want to get my hands on that, well, the good news is it's free. You can go to dandoesdeals.com. There's this great big button where you can download and print it out. And like a complete dummy, I don't ask for any contact information or anything, which that's the cardinal sin of marketing. You should always ask for some sort of contact information in return for your freebie. But I realize that this industry and your career in commercial real estate is going to hinge on your ability to effectively communicate on the subject of commercial real estate deals and the roles in it. So that's why I make it available the way I do. And also I go through all 6 sides in every episode so you know how my guest fits into these deals. So let's get started. The repositioner is the first role that I want to talk about. They are acquisitions people. They're looking at a bunch of different properties to find those diamonds in the rough, and they're doing a whole whack of paperwork to pull it off. They are underwriting the deal, which means they're doing the math and they're doing different projections to figure out how are they going to find more upside, and also even finding out, is this property even making the amount of money that this seller slash broker claims it is? Because okay, so one job of the repositioner, though, as they're finding this upside, it's a little bit peculiar seeming, but the repositioners need to do a lot of financier relations. They need to have a wide network of people who can lend money or invest, the banks and whatnot. And the reason for that is because if the repositioner can secure a more advantageous loan, that goes straight to the profitability of the building. In other words, that's upside all baked in just from the loan or the startup capital that they're able to get. So they're going to talk to lots of financiers, and that's the reason why. But the repositioner's next job is to take a look at the operations and say, how can we get those Benjamins to stop going down those toilets? But of course, there's more to operations than just unclogging toilets and mowing lawns and collecting rents. Me personally, when I'm in an asset management role, the contributions that I make, one of them is any technology that needs to be done, like web applications and all that kind of stuff. And of course, if you're selling it at a cap rate, that means that any reduction in your expenses is going to make a disproportionately large difference in the value of the property. But the other thing that you have to realize is, even if you're like me and dealing with properties that are 100 units or more, preferably, the thing that is going to make or break your deal, the real enemy in real estate, is vacancy. And so even if you're outsourcing the property management to a third-party company and they're responsible for filling the units, if that doesn't pan out, somebody on the GP team has to have some serious marketing chops to be able to fix that up, and that's where I come in. But there's only so much you can do as an operator or a repositioner in optimizing the operations. So the next place that's frequently looked to is the contractor team to do a value add, renovate, and make the place nicer. And then that way, residents are more than happy to pay more in rent than the in-place ones. And so that is another way to find the upside. But if only it were that simple. You can spend endless amounts of money on construction. You can go ahead and gold plate the toilets if you want, but you're going to get no return on investment whatsoever. So that's not a great idea. But the other problem that can arise from dealing with the contractor team, especially if you're like me, I don't know if you know this, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can keep an eye on those contractors and operators that are in place. And if something bad happens, they can be there in an hour or two. Because categorically, that won't be me, because I'd still be stuck at an airport in an hour or two. So somebody needs to be way closer to the property on the GP team than I am. But of course, when you've got that local and you've got these different parts of the team put together as a repositioner, and let's say you're getting into commercial real estate and you want to, you go, hey, I know how to buy a house. You have your deposit that you put in, or your down payment. And then if you say, hey, but there's a 350 unit apartment complex just down the street, maybe because, all my friends are engineers or physicians or attorneys or whatever it is, we'll just pool our resources and take over that building. So you turn around to the financiers, the banks, and say, hey, this property, it's 350 units, it's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you happen to want to lend us, do you? Well, the financier is going to have one burning question that I haven't addressed, and if you're in a guru or mentorship program, I recommend you listen very closely to this next part, because they usually gloss over it something fierce. And the financiers are going to ask the question, who's the sponsor? who's the KP? Who's the key principal? Who's the main person who is taking over this deal? In other words, who can sign on a check that's millions of dollars? But more importantly, you in that hypothetical with your friends putting your 100K in each, it's going to fall apart because somebody in the deal has to already own a similar asset. So in other words, if you're buying a 350 unit apartment complex, somebody has to already own a 350 unit apartment complex. That way you're showing the bank that you're not going to run the property into the ground. And on top of that, you need a certain amount of liquidity. And then among the GP team, you need a balance sheet of at least the amount of the loan. You have all those pieces, you got yourself a commercial real estate deal. So Josh, you already mentioned some of the skills that you contribute to your deals, but there's some virtual assistants in the audience who are typing this up for people's investor bases. So at the risk of repeating yourself, which boxes do you intend to check on your next deal?
Yeah, no, thanks. That's a good summary of the team that's involved. And I'm a big fan of the book, Who Not How. And so I try to stick to the things that I'm good at and find people that are good at the things that I'm not to do those. And so maybe an easier way to answer that is which of those six things am I not good at that I outsource? So I'm not a contractor. Like I don't know anything really about construction. I know very little. That's something that I outsource to someone that's what they do for a living, right? And the operations side too. That's something we hire a property manager for, an asset manager. Um, but yeah, I wear a lot of hats. Repositioner. I mean, we're doing stuff ground up development, so that's kind of like the ultimate reposition, right? Taking a piece of land and turning it into something that wasn't there before. I do all the financing for our projects, do all the underwriting, secure the debt, the equity. So I'm heavily involved there. Local, we're boots on the ground. I'm based here in Salt Lake City, Utah. We only do projects that are in Utah, and so that's intentional because that's what I know. That's where I've worked for the last 20 years, and that's just what I feel comfortable doing. I can drive to any of these properties at any time, see what's going on, fix any problems.
Mm-hmm.
And then I also do some of the sponsor. Our projects are small. We're not buying 300 unit buildings like your example. We're building more kind of 20 to 30, maybe up to 50 units at a time. And so I can act as along with my other partners as the sponsor. Actually taking the risk and responsibility of signing on the loan for those projects.
Mhm. I love that answer. And of course, it's funny when people are coy about the unit counts, especially when, a 20 unit in Salt Lake City can cost more than an 80 unit in other parts of the country. So
Yeah, it's
there's
relative.
definitely,
Yeah.
yeah, exactly. It's definitely relative. But the next question is about the buy box, and Josh already covered one part of it, which is geography. If you're going to be talking to another real estate person, you say, hey, what's your ideal property? What's your buy box? What you're looking for? We're asking about three things. First one's geography. Where is it? So in other words, which state, possibly which county, possibly which neighborhood. Okay, if you're going to call it ideal, then that's going to be part of the equation. The second one is size. Most of my guests on this show are in multifamily, and the way that you define size in multifamily is by the number of apartment units. As a matter of fact, a lot of people use that as their way to mitigate risk because the number of residents that you're getting income from, it's not as bad if you have one empty unit in a 100 unit property as it is if it's a single family, which is a terrifying prospect. Is for the cost per door. So that's the size, and other types of commercial properties they go off of square footage, but that's always going to matter because the type of group that's going to take over 10 and 15 unit apartment complexes are going to be fundamentally different from the type that are taking over 150, 350 unit buildings. So that's very important. But the third one, I call it desirability. The more common term for it is class. And the reason why I don't like the word class is because it's very clearly two separate things. The first one's condition, the second one's area. When you're talking about condition, you're talking about how old is the property, the building, the facility itself, how beat up is it, and then of course what kind of luxuries and amenities are included for people who are residents there or tenants if they're if it's a strip center or something like that. Then when you're talking about the area, however, if it's multifamily, the school districts are going to be very important. But in every type of real estate, the crime rate's going to be important. And then I like to hit that old trope of how people say, oh, location, location, location. I don't think that that's very descriptive. I don't think that tells people much information. And what they really mean is traffic, traffic, traffic. In other words, the more people pass by a given property every single day, it's automatically going to have more baked in desirability. And both the condition and the area, I've got the directions mixed up, both of them are ranked the same way as in grade school, where you got A plus at the top, and then A, and then A minus, and B plus, and so on. So Josh, as far as you and your organization goes, what's easier to say yes to and more difficult to say no to, even though you said it's going to be in Salt Lake City?
Yeah, well, yeah, we like to stick to Utah, and kind of our criteria for market is we actually have a hard time doing anything in Salt Lake City, and we like to be a couple steps outside in the path of growth. Our ideal market is somewhere where there's a lot of growth in population and jobs, but the supply of whether it's housing or industrial space hasn't caught up. And we like those places where the supply and demand is a little bit out of balance, and we think there's opportunity there. And so, yeah, as far as geography, that's what we look for. We can't compete with the big guys, right? That are in Salt Lake City and can pay those kind of prices and do those kind of deals. And so we're a much smaller operation, and we like to be, in the path of growth, a couple rings outside of Salt Lake City. So. As far as
Unit count?
unit count, yeah, I mean we're pretty small. We're kind of infill, and there's pros and cons of doing a big 300 unit project versus what we're doing, which is kind of 20 to 50 type units. We feel good with that size of product. It's less risky to lease up, right? There's fewer units to lease up. And what we're doing is we're building a lot of townhomes for rent, and so we can actually, we can lease up individual buildings as we're going, and instead of wait for a whole 200 unit building to be finished to start leasing. And we just like that space. It's a good niche for us to be in. And then as far as class, we're building everything from ground up, and so it's hard to build anything less than class A or class B plus, just with where costs and interest rates and everything are. And so we're building a really nice product that's brand new. And yeah, that's kind of what we're looking for.
Perfect, perfect. So we can talk then about people. And my favorite thing by far about commercial real estate is that because it's a team sport, people are really eager to make introductions, referrals, build new teams and all that kind of stuff, even if they're not a part of them. But when it comes to teams that you are a part of, the fact is we've all got our own unique skill sets. So that means we're better suited or basically better leveraged to help some people more than others. And in general, it's the sponsors and KPs that I keep on finding I need more and more of. And it used to be because of my marketing and tech background and the fact that I'm from the internet. But now it's also a matter of having the people who actually have the deal flow where even a debt fund or something that I'm a part of can help out. But of course, I'm also always eager to talk to different locals, contractors, repositioners, all of these different things just in the context of this show and helping this community grow. But Josh, if you have any 506B deals going on, don't mention them specifically, especially if you're going to say I'm looking for financiers. But who's on the die that you can disproportionately help?
Oh yeah, I mean we've done both. So we syndicate our projects, and we've done 506B and 506C both. And we don't have an active 506B right now. We have an active 506C as of the day we're talking. But for me, I really I just want to help people. I think there's a lot of people that want to be in real estate, want to invest in real estate. They understand the benefits of it, but they don't know how to do it or how to get into it, or maybe they don't think that they can. They don't have $1 million saved up, and so they think, oh, I can't do anything. And so part of what I get a lot of fulfillment out of is helping those type of people, just kind of expanding the opportunities and explaining. So a lot of our investors are kind of, in the $50,000 kind of range. And for a lot of them, it's their first time investing in something like this. And so I really like that aspect of it, of, helping, kind of open the vision of what's out there and what's available, and then walking them through the steps of um, you know, I love explaining, the deal, walking through it and answering questions. And so those are kind of our ideal people that we like to work with and partner with.
I love that answer, especially because, some people they'll similarly say, "Oh, I can't get involved in deals just because they think that you need to spend five figures on your education, even though like there's so many resources available for free on
Yeah.
YouTube and whatnot." But of course, it means that those of us in the industry, we become curators of information, even if we're not creators. So I absolutely love this answer, and I'm sure there's plenty of people in the audience thinking, "How do I reach out?" Well, first, I'm going to hijack it by saying, how do you reach me? And I've got this super duper distinct last name, and I spend just a ton of time on LinkedIn. So that's the best way to reach me. If you have your phone handy, you can scan this QR code, which brings you to the FAQs page of 506 BME, which is the platform that I offer to different syndicators where I will help you with your documentation of your substantive relations, so that if your laptop falls into the bathtub and the SEC audits you, you still have that proof that you knew these people before they got started. And of course, I got some funny books like Real Estate is a Scam. It wasn't supposed to really be that funny, but that's available on Amazon.com. But Josh, we met first on LinkedIn and then out in Phoenix. What are the best ways to reach you?
LinkedIn for sure. I'm on there all the time, and I try to, put content out and help people out, however I can on LinkedIn. So yeah, that's the best place to find me.
All right, perfect. And then the last part, it's actually not for you, Josh, it's for you in the audience. It's my public service announcement that I always do. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine like symptoms, it's certainly because of the hideous subscribe button that's down there, and you can get rid of it for free. You hit the thing and it just goes away. And as full disclosure, I want a lot of people to hit it, because if enough people do, YouTube will actually start paying for these videos instead of me. And I think that would be amazing. And as far as trade-offs to you, just so it's full disclosure, it means that my videos may show up on your list of suggestions, but you can quite frankly ignore those suggestions, and that's perfectly fine, because I really appreciate just the fact that you spent this time with me. Just like Josh, I appreciate you joining me. This has been great.
Yeah, thanks for having me. Yeah, it's been fun.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506 BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, You can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506 B me, everybody.